Hey there everyone, Ryan Schul, welcome to my channel. So this is all about data science, machine learning, deep learning, artificial intelligence, and things such as this. So in the project today, I want to analyze financial products and look at market risk, and we'll be using Python, of course. There's several asset classes that we're going to look at: ABSs, CMBSs, CLOs, BCDs, BDCs, loans, bonds, and equities. Okay, I have some notes over here, and these are the ticker symbols that represent proxies for these types of asset classes. So I'm going to go ahead and grab this from Yahoo Finance. It's pretty easy, pretty straightforward. I'll show you how to do that. Now, in your real business, like if you work in a market risk business, your securities are going to be different, right? These are just proxies or benchmarks for indices that represent these asset classes, but obviously your ticker list is probably going to be very significant different from mine. But then again, some of these asset classes are actually pretty hard to get. Some of them are not necessarily, a lot of them are not necessarily in the public domain. So I can't look at actual assets, but we can represent those assets by these types of classes, which are pretty realistic benchmarks. Okay, so what's an ABS? It's an asset-backed security. These are bonds that consist of assets like credit card receivables, auto loans, student loans, things like this. CMBS is commercial mortgage-backed securities. So this is a type of bond or bond pool backed up by commercial real estate, office buildings, malls, things like this, right? They package these into tranches and chop those up based on maturities, risk profiles, and the coupon payments will be relative to the riskiness of the investment instrument. Okay, so what's a CLO? It's a collateralized loan obligation. This is a structured credit product backed by a diversified pool of corporate loans, often leveraged. So these can be higher risk, but higher coupon payments. All right, there's always a risk reward trade-off. You want lower risk, lower coupons; higher risk, higher coupons. BDC is a business development company, so it's essentially like a private equity company. Think something like venture capital that actually issues debt and equity so you can invest in these things. So that's pretty cool, because a lot of times you can't invest in a PE company or a VC company, right? It's not available, but through BDCs you can. A bond is a fixed income security where investors lend money to issuers. It can be corporate, it can be government, it can be muni, which is short for municipality, right? In exchange for periodic interest rates. And at maturity, your principal is returned. So my wife and I went to go see a financial planner about this exact thing I think it was just about over a week ago. Yeah, a week and a day. So we were interested, just hypothetically, if we dump $2 million into a few high coupon paying bonds, what can we expect in terms of cash flows? And the answer was like close to $200,000 per year. And if you get triple tax-free munis, that can be some serious money, right? If you're getting $200,000 per year on a 30-year maturity, and then you get the principal back at the maturity of that investment vehicle, like that's a phenomenal offer. Now, in 30 years, obviously, there's going to be some inflation, and the $2 million that you get back is not worth as much as $2 million today. That's pretty much a given, but it's still a pretty good opportunity, right? And equities are basically just stocks. So these are corporate issued stocks. Think Amazon, Microsoft, Google, things like this, right? So we're going to go ahead and import data from Yahoo Finance. And again, these are not exactly stocks or bonds. These are proxies for stocks and bonds and BDCs and CLOs and ABSs and things like this, right? So I'm pulling in all the data from Yahoo Finance. I am going back 3 years in time. So the number of years is 3. This is going to be the end point is today. The start is end minus 3 years offset back in time. So the end date is going to be, our start date is 3 years ago. Okay, it's mid-June, June 17, 2025. Today is my son's 9th birthday. He's pretty excited about that. So we go back in time 3 years, right? And the last thing we have here is for yesterday, right? So this is daily returns for all of these benchmark proxies. So the first thing I want to do here is compute VaR and CVaR. So what is VaR? VaR is value at risk, and this is typically set at 95%. It could be higher, it could be 99%, it could be 90%, but it's always for a certain duration of time and a certain confidence interval. In this case, I'm using 95%, right? So the calculation is very straightforward. It's portfolio returns, which we just calculated above, right? So portfolio returns comes from returns, and here are the returns. So prices, percent change, and drop NA. We don't necessarily need drop NA, but with the prices and the percent change, we can get returns, right? That's one thing that I love about Python. It's so compact and so efficient. Just with one line of code, we have all the returns for the entire portfolio, right? So we pass that down to portfolio returns. The second parameter here, this is comma separated function. 1 minus confidence interval times 100 to get that into a percent format. And then the CVaR is the basically expected shortfall or the average loss in the worst case scenario beyond the given confidence interval, right? So it exceeds VaR, and it shows you like a really bad case VaR. Now, I suppose hypothetically the worst case could be portfolio loses I don't know, like 90% of the value if there's a massive market drop, but realistically that's probably not going to happen, right? So we would just want to know within a certain confidence 95% of the time how much is the portfolio going to drop. So we have the answer right here, negative 0.73%, so 0.7%, and an extreme VaR or expected shortfall, in this case CVaR, 1.9% drop in the value of the portfolio. Okay, so let me go down here to this next cell and just show you what the plot looks like. So again, this is for the entire portfolio. Here's the VaR. The CVaR is always going to be a little bit lower, and you can see this is just about 1%. If I zoom in, you can see probably the numbers down here. So if I go over here, yeah, 1%, and this is 0.75, right? If I double click, I go out. So this is for the whole portfolio. If we want to get asset by asset, VaR and CVaR, we do exactly the same thing and just put this into a loop. So for ticker and returns, individual returns is equal to ticker, the same exact formula that you saw above, NumPy percentile. Individual returns, 1 minus confidence rate, that came from over here. So same exact thing. All we're doing is looping through each one to get the security level, VaR and CVaR, and that is portfolio return of the portfolio returns less than or equal to the VaR, right? So here's the VaR and CVaR for each symbol in the portfolio, right? So we can get individual asset returns, and I'm going to plot each one just to visually see what all of these VaRs and CVaRs look like. So this is BDN down 4%, and the CVaR is kind of hard to read that, 5.7, I think. So if I go over here, BDN is 4.07 and 5.80. Okay, so that's the VaR and CVaR plotted. So yes, so at this point I want to look at a different perspective here. I want to go ahead and shock the portfolio, and this is going to be adding a synthetic or an artificial shock or like negative impact for the portfolio. And I'm going to, I set this up so I can enter different values so I can see what kind of impact it has. The impact date, I'm going to say, is January 1st, 2025. Now, just hypothetically, there's a big event and AAA right here. Remember, this is a proxy. This is a an index here. It's not a AAA stock or whatever. But I'm going to change this, and this could be any ticker that you pick, or you can pick a series of tickers and a series of dates and add multiple shocks. I'm picking one ticker and one date at this point. Make sure that the date is a day that the market asset is trading. If we don't have a trading date, then this is going to crash. If I put in 10%, the shock to that one ticker right here, AAA, I'm saying it's going to be down 10% on this one day, not just hypothetically. I want to see what kind of impact that has in the portfolio, so I can zoom in over here. So January 6th, right? This was the shock date. And you can see immediately after shock is the red line, and the blue line is before the shock. So these follow each other kind of close, right? It's not perfect, and it shouldn't be perfect, but it's simulating what would happen if that stock was had depreciated 10% on that day. Let's add a bigger shock and see what the effect is. Let's say 35%. And this does happen, right? Sometimes stocks open 35% down from close the previous day. So if we add in this shock to the system, let's see what kind of impact we have. Okay, we're assuming AAA drags the portfolio down. But again, it depends on the weight. If this is a smaller position in the portfolio, it might not have much of an impact at all. If this was a substantial position in the portfolio, it's going to have a major impact on the portfolio, right? So when we do these shocks, you want to make sure it's done on positions where you own a lot of shares, or it consumes a lot of the percentage of the portfolio, right? Because if it is only 1 or 2%, it's really not going to have much of an impact, okay? So again, you can see this is the shock date, and this is the future payoff right here. So the portfolio is being dragged down a little bit, but nothing else has really changed here. We just have a slightly lower base and from a one-time hit, right? So these two lines track each other pretty steady, and again, it's just one stock going down. A more realistic scenario might be to introduce a little more stochasticity. So a stochastic event is an event that's much more random. There's a book that came out many years ago. I forgot the author's name, but you can Google it. I'm sure it's the first thing that comes up. It's called A Random Walk Down Wall Street. It's very interesting. I would definitely recommend it to you. And stocks tend to move in random patterns. It's also called stochastic movement, right? So it's hard to predict what the outcome is. And if a stock drops 10% or 35%, like we just saw, it could still track the overall portfolio, and the whole portfolio could be somewhat similar. But a more realistic assumption would be that the outcome would be somewhat random after the shock event, right? So we'll use the same date, 2025, January 6th. Now I'm going to look at shocking 3 different securities in the portfolio, and I will put in a 20% drop and see what the impact is here. Okay, so somewhat substantial. Now we see more stochasticity, right? So it doesn't follow the same pattern that we saw before, right? The red and blue almost intersect over here. Then the red goes down again, okay? And it's much more random, which represents a real world scenario, right? So the split right here between these 3 stocks, and again, there's much more weight between 3 stocks than for one. So there's a bigger drag on the portfolio, right? So the blue line would be no shock, and the red line shows us the shock to the portfolio. And I think I just did 20%. Let me just do a bigger one just to test one more idea. If there's a 40% drop, now you see a real impact on the portfolio, right? So 3 stocks all simultaneously drop around 40%. Probably unlikely for all 3, but we could actually test different iterations, different scenarios, different simulations, and see what the outcome would be, right? So I'm just making some general assumptions here. In a real risk management environment, you would probably do more of an iterative process, more simulation analysis, or even scenario analysis, where you look at maybe a dozen different scenarios and how that would impact each different stock and assign different weights to those or something like that. I actually didn't do that only because I just thought of the idea right now, and I already started the video, and I'm already about 15 minutes into it, so I'm not going to go back and re-record it, but that would be a good exercise to see that. And I do have a couple videos on my channel about simulation analysis and scenario analysis, so I would encourage you to check those out. That's 2 concepts that are used all over Wall Street, very popular, and even off Wall Street too, right? If you want to create different probabilistic outcomes, any kind of scenario analysis would be great. And if you want to do more of a Monte Carlo analysis, that would be simulation analysis, where you look at tens of thousands or even hundreds of thousands of potential outcomes, and then look at the probability of each of those potentials. So stress testing basically helps you understand the impact on the portfolio under extreme conditions that are plausible, but probably mostly unlikely, but very adverse if it does impact your portfolio, right? And it answers questions like, what happens to the portfolio if there's a big drop in one or multiple assets, in this case, CLO, or interest rates crash suddenly, or oil prices crash, right? This is real stuff. This really could happen. Now, it's more of a rare event. It's not a daily occurrence, but I mean, from a risk management perspective, totally makes sense to do these types of exercises, right? To see what the potential negative impact is going to be on your portfolio. So this is an interesting concept. Hit rate basically shows us our based on our trading strategy evaluation, how often does a trading strategy result in a profit? We can look at portfolio analysis, what fraction of days did the portfolio generate a gain? And we can look at VaR backtesting to see how often did the actual losses exceed the predicted VaR. So in this case, what are we looking at? Trading, how often did the trading result in a profit? 54.62% of the days, that is our hit strategy, right? 54.62. And we can look at this cumulative hit strategy over time. So 54% of the time, we're generating profits based on our investment strategy. And the first few days, it's going to be very choppy. It's going to be a lot of up and down, but then it evens out and kind of balances as, or just not balances, but the big swings cancel out as time goes on, and ultimately the portfolio is down about 54%, 54.76, and that's what you see over here. So there's the hit rate. So most of the time we're making a profit. So down here is 0, over here would be 1, but like 100% of the time we're making a profit. That's very unusual. I think 54% is much more realistic. So one more thing we can look at this is how often did actual losses exceed the predicted VaR, right? So we have the VaR. I talked about that at the beginning, the value at risk. So how often did actual losses actually exceed the value at risk? It should be a pretty small percent of the time, because remember, we set that confidence interval at 90%, right? So 95%. So 95% of the time, the portfolio should not exceed the VaR, but it certainly could, right? There's no guarantee that it won't. It certainly could. And we can see in this case, it's 0.026, that this is the 5th percentile. And this is a VaR breach where the portfolio ended up lower that trading day at the end of the day than we expected. And the VaR at 95%, was the breach actually worse than the VaR? That is negative 0.0072%. Okay, so overall, pretty good strategy. Basically, the portfolio is very balanced. We have all of these securities I showed you at the beginning. Right? I think there's 23. All of these securities are in the portfolio, all of these tickers, right? So you have pretty good diversification between ABSs, CMBS, CLO, BCD, loans, bonds, equities, right? So very good diversification, and the portfolio is pretty stable, right? It's not totally immune to shocks, as we saw, but it's going to be pretty stable portfolio, right? So remember, BDC is business development company. This is access to private equity, to venture capital, so PE and VC. And it's a nice way for like a small investor, either a private investor or an institutional investor, to get access to things that normally you would not have access to, right? So BCDs are basically structured similar to publicly traded companies, allowing investors to participate in the growth of these smaller businesses, these VC investments and these PE investments, similar to what you would see in the stock market. So let me introduce you to this concept, skewness. So skewness is a dispersion around the mean. So the skewness of the total portfolio returns is 18%. Basically, this shows us a multiple of stocks. It's really more like ETFs, by multiple ETFs, and comparing portfolio skewness before and after. Let's an analyst do the following. Basically understand tail risk sensitivity. Does the portfolio become more left skewed or higher downside risk after the shock? We can see evidence of that. Stress test asymmetry, shock certain sectors of assets to see if it increases the chance of larger losses, and compare robustness. A well-diversified portfolio should show less skewness after a shock. Okay, so before a shock, we're expecting the distribution to be pretty much normal, right? And if there's a big right skew, you'll see a big fat tail off to the right. If there's a left skew, the tail goes off to the left, right? It's skewed to the left or to the right. Wait, I think I said that right. Did I actually get that back? Let me Google this. I haven't got this concept in a little bit. Give me a second. Left, right skew. So let me see what this thing says. Right skew, yeah, that's what I said. Okay, so if there's a big tail to the right, right skew, big tail to the left skew. So that's pretty intuitive, right? So when we go ahead and apply multiple shock dates, I have 3 trading dates. So January 6th, February 10th, and March 14th. And these 3 securities, and these are going to be the shock levels. Okay, so 10% depreciation in this stock when the market opens, 15% for this, and the QQQ goes down 20% on these 3 days. What is the overall skewness before the shocks and after the shocks? I think I just refreshed it, so I'll do it again just to make sure. So before the shock, 0.177, after 0.185. So not much of movement there. If I increase the shock amount to 0.2, I'll make this 35, and I'll make this 0.5. If these numbers stay relatively the same, yeah, this goes actually down a little bit, right? And before the shock, that was 0.177. So basically, this tells me that the portfolio is pretty stable. Like it's not really impacted by these point. Let me try just a small, just to see what this thing looks like. 0.02, negative 0.05. Yeah, so small shock and barely any change, and big shock like we just saw, still a change, Control Z to undo. Okay, and 0.177, 178, almost the same thing. When you add the big shock, 0.177, 0.130, but not a huge change, guys. So basically, we have a lot of diversification in this portfolio, and even after a pretty major drop on 3 dates for 3 securities in the portfolio, because everything is normally or evenly weighted, right? If we had higher weights in these 3 stocks, you would see a bigger skew, right? But everything is equally weighted, and the portfolio is so well diversified that even a big shock really doesn't have a major impact on the overall value of the portfolio. So we're pretty safe. This is a good spot to be, right? So basically, this suggests the portfolio distribution is fairly symmetric and it's diversified. Okay, so what else do I have down here? Oh, beta versus SPY. So beta is the sensitivity of a stock to, in this case, it's an ETF, to a proxy, right? So a common example would be if the beta of Apple was greater than 1.0, when the market moves 1%, Apple will move up more than 1%. If it's less than 1.0, if the beta of Apple was 0.95, the market moves down 1%, then Apple would move down 0.95%, right? So the higher the beta, the higher the volatility, lower beta, lower vol, okay? So we can look at the volatility for every security in the portfolio and see that all of these have under 1. Oh no, there's a couple 1.0, so that would move about 1% when the market moves. This moves 12% up when the market's up and 12% down when the market's down. And this moves 23% up when the market's up, 23% down when down. These hardly move at all. So these right here are pretty stable. So if you want to pick a bunch of stable securities and have a diversified portfolio, this is what you want to look at. Now, the returns are probably going to be diminished as well. So if you want to assume more risk and underwrite this risk and you have an appetite for risk, then you would invest in these securities. These have higher betas relative to the benchmark, okay? So here is basically the same thing illustrated in a plot. Higher numbers mean more movement in the asset when the overall market moves, right? So the QQ2 has the highest, 1.23. That's what we saw over here. And BDN is the second highest, 1.12. Okay, and the lowest is ICSH. And that doesn't even really register. And over here, it looks like not even 1/10 of 1%. It's like 3/100ths of 1%. Okay, so very low beta, very low movement when the market is up or down. So the last thing I want to show you here is a correlation matrix. This shows you how correlated every single stock is to every other stock. So on the diagonal, you'll see the correlations with each other stocks. The darker the color red, the higher the correlation. So AGZ, and going down here, AGG, high correlation, TLT, and AGG, high correlation, very high correlation here, MBB and AGG, and so on and so forth. So if you have a dark blue, you'd have low correlation. It says 0. We have a couple negative This is negative 0.08 and 0.02 and 0.8. So this is just a mirror image of the other. And again, if you want to have stocks that are a little bit more risky and you have the appetite for that level of risk, then you could go ahead and combine securities that have high correlations together. When the market moves up, probably most of these are going to move up in unison. When the market goes down, probably most of these are going to tank just as well, right? But if you have more diversification, so you have stocks that have almost no correlation or even negative correlation, then when one side moves up, the other should move down relative to that proportion, and vice versa. If you have one that moves down, then the other should move up if they have negative correlation, right? Because they don't move together, they move opposite. And high correlation means that those stock prices, or not stocks, but in this case, ETF prices or index prices will move together, right? So that's it. I'm going to wrap it up here. I think that was good. 25 minutes. We just said 26 minutes here. I think that's good enough. Just wanted to drop some knowledge on you. Hopefully this is useful and informative and somewhat inspirational. If you can consider this inspirational, that would be amazing. But hopefully you get out of it what you put into it. Copy and paste the code, run it for yourself, and see how it performs. I will share this code with you later today when I drop the video on YouTube a little bit later in the afternoon. And I will share this HTML file so you have all the source code with the video, and you can take this for a test drive and see how everything works on your own PC. Okay, so I'm going to wrap it up here. Thanks for your time today, and I will see you guys in the next video. Talk to you soon. Bye.